Why is everyone suddenly bearish again? Hi, everyone. Welcome to the Real Vision Daily Briefing, helping us make sense of the markets today. I'm joined by my colleague, Andreas Steno Larsen. And a little bit later, Jeff Meyers, the CEO of Cobia Capital, will be here to drill down into the small cap area and highlight a couple of opportunities he sees. But Andreas, let's get this sort of big picture first. And there's a lot going on. This is the first full trading week of December, the last month of the year, which is always kind of action packed, but there seems to be a lot going on today and a lot of red, right? We see equities, US equities just closed with losses across the board. Energy also lower today, leading the way. Crude down 3%. Are we seeing a turn in sentiment? Is it just me, or do you feel like a lot more people sound like they're getting bearish again?
No, I perfectly agree. I've seen at least a couple of big institutional investment banks saying the same over the past week here. I've seen various big Twitter accounts turning bearish over the past week. So I think you're onto something there, Maggie. And in terms of today's price action, I find it kind of interesting that we are back to the good old pattern of good news equals bad news. We had a tremendous report out of the service sector in the US, but apparently that's bad news for equities, since it kind of puts a question mark in front of what Powell told us just a few days ago.
Yeah, not what the Fed wants to see. Although maybe giving fuel to some who keep talking about a soft landing, but I don't know. We know the Fed is really determined to try to get a hold on inflation, and everybody was encouraged when Powell suggested they might sort of start to pull back a little bit on the intensity of the rate increases. What's going on? I mean, why isn't that good? Why are we not saying, oh, this is a soft landing, we can got to get the best of everything? Why did everyone immediately go bearish?
If we look at the sub-indices of the service PMI out today from the US, I think we have a couple of interesting things to point out. First of all, if we look at the price survey, so the survey that asks companies for the input prices in the service sector, we are still at a territory around 70 in that index, which basically means that you should expect service inflation to print in the range of 5 to 6% on usual correlations. So I guess that is the thing that you need to point out from today's survey. The sticky component of inflation, the service inflation, will remain high on historical correlations, given this print of 70 in the service price survey.
Yeah, and that means potentially that's going to raise concerns about wage inflation, right? If we're all spending on services and eating out and doing all that kind of stuff we haven't been able to do. And we know the Fed really cares about that in the labor market. Do you think you think the Fed's going to message that they're walking back that 50 basis point cut in December? I mean, is that what we should be bracing for? And what does that mean for equities?
Watch the inflation report first, but I wouldn't rule out that they will have to at least open the door for prolonged interest rate hikes more than 75 basis points at the next meeting. I think the tool that they will use from now on is to keep signaling that they will hike until the service inflation is in a territory where they like it to be. And as a consequence of today's survey, I would argue that we need to reprice the Fed a little bit in an aggressive direction again. And I think that matters a whole lot for the equity outlook overall, especially given the optimism that we've seen on the back of the last two inflation reports pointing in a negative direction or in a disinflationary direction, mostly due to goods disinflating. But if services don't follow south, then I guess the Fed will need to hike for longer.
So why do we see oil prices down as well? Because if you think the economy is running strongly, then that would be, you would think that could, give a boost to energy prices. But we saw it move in the other direction. But there's a lot going on. So what's driving on the energy front?
I think we need to look at the material discrepancy between the outlook for the manufacturing sector and the outlook for the service sector. We had the ISM manufacturing outlook out on Friday with a negative print, also below expectations. And if we look at the energy consumption in the manufacturing sector, it's obviously much higher than in the service sector on a per capita level, which means that when activity is dropping in the manufacturing sector, it is a signal to the commodity market to sell off, in my view. And I think quite interestingly, what we see across the board in sort of energy intensive companies is that the demand is dropping now, while we see the demand moving from production and manufacturing to the service sector quite materially these months. And that is a move that needs to be reflected in the commodity space as it is a move from more energy intensive consumption to less energy intensive consumption. I can maybe bring up a chart that kind of shows where I'm headed here, because on chart 2, Claire, we have a chart on the running price of transporting a container from Shanghai to Los Angeles, basically, in dark blue. And in orange, we have the PCE goods index, so the goods inflation index measured by the Federal Reserve. And quite interestingly, we see in the demand for transportation, basically, or for transporting containers from Asia to the West. And I think that's a material signal that the amount of goods purchased in US households and European households is on the way down, and the corresponding activity in the manufacturing sector is on the way down as well. I think that's noteworthy for the energy market.
So what do you make of the fact that OPEC Plus decided to hold steady on output?
Well, they will hold steady at around 29 million barrels a day, which is still a decent number in a historical context. So from a supply perspective, we didn't really get any negative surprises through the weekend. And if you pair that with the story unfolding today, that the oil price cap implemented by the G7 countries on Russian oil, I tend to think that we net received positive supply news from Friday until today. And I think that's essentially why you see this reaction in the oil market. If we look at the dynamics right now in the oil market, I find it interesting that we received a message from the Saudi Arabian oil company Aramco earlier today that they will lower the premium on Arabian light oil sold to Asia to just a few dollars above the benchmark. They sold that exact same oil at almost $10 in premium to the crude benchmark earlier this year, which is an interesting change of scenery, because to me it is a signal that either Saudi Arabia is scared of waning demand in Asia, or else they are kind of scared of Russia flooding Asian markets as a consequence of this G7 oil price cap. So if we look at the details of this oil price cap, essentially what we know is that the European Union will at all, while the G7 countries have agreed to make it difficult for other countries to buy Russian oil at a level above $60 per barrel. But if we look at most Russian benchmarks, they are already trading just south of that $60 a barrel benchmark. So to me, it's not really a biggie from a supply perspective. And I think a lot of oil market bulls had expected this oil price cap to withdraw if not 2, then at least 1 million barrels a day from the market. And for now, I simply cannot see that supply constraint as a consequence of Russian oil already trading below the cap, and as a consequence of the mere fact that oil always finds a way. It's almost like water, right?
Yeah, absolutely. You know, it's interesting. You're trying to figure out, it's such a difficult environment. We've talked about this a lot, trying to figure out these very unpredictable geopolitical pieces that are going to fit together. I had a chance to sit down with Diego Parilla of Quadriga as part of our Don't Wait for January series, kind of talking about these big themes that people need to start plugging into now. And he thinks we're in the midst of a paradigm shift where higher volatility will be the norm across a lot of different asset classes. Let's have a listen to what he had to say.
For the time being, inflation is the biggest concern, and we're hiking rates aggressively to try to contain it. But I think it's we'll see if too little, too late, but certainly too late. And to the extent that a lot of those excesses and imbalances are already in place. And as we do that, I think we are likely to result in an environment of sustained high inflation. This is arguably the single biggest, most important thing investors need to get right, inflation. But I think that including that volatility around inflation, which we could see, there's a very polarized view of the world. It's likely to result in high volatility in markets, and I think this is linked to high risk. So this is a new paradigm of significantly higher volatility, significantly higher inflation, and significantly higher risk.
It was such an intriguing conversation. I encourage all of you to go check out that full interview. We'll be dropping on our website for members tomorrow, Tuesday, December 6th. So Ralph High is asking a question, what are the three things people aren't talking about enough in macro? Clearly, Diego thinks inflation is one of them. But I'm just interested to get your thoughts on that, Andreas. I mean, it is an interesting idea. And we certainly see very divided camps on what the forecast will be for things like inflation.
Let me answer that question with a response on inflation as well, because I frankly think it's the most interesting topic right now. If you look at the inflation picture in the US right now, I think we have a huge discrepancy between the outlook for inflation on goods versus the outlook for inflation on services. But what we don't discuss enough is that given the change in consumption patterns through the pandemic, the updated weights in the inflation index back in January this year will favor a bigger sort of weight to the goods consumption as a consequence of all of the goods purchased by households through the pandemic. So if we have a disinflationary picture in goods relative to services, then I actually think it will almost get too much weight in the calculation as a consequence of the weights being updated right after the pandemic. And they only update these weights every other year. So it basically means that we will wait another year or so before we get updated weights again, right? And therefore, if goods drop in price, even if service inflation remains sticky, then I guess the overall picture will actually look fairly benign for inflation into next year. So what I watch right now is the picture in goods inflation, because it clearly points south to me, and I don't think it gets enough airtime.
Yeah, that's so interesting. But I mean, is that a false narrative? If there's still all this service inflation that's not being captured, does it matter?
It is a false narrative in the sense that with updated weights, they would probably come up with another bottom line. But still, in the meantime, it's very tricky for the Federal Reserve to sort of explain that away with technicals, right? So they will have to at least partly adapt to the reality of a goods inflation that prints lower and lower, and a goods inflation that has a lot of emphasis in the overall bottom line.
Yeah, it's so interesting. And I can hear all the people, that talk about technology, including Raul, talking about, well, if there's service inflation, does that matter and filter through if you've got, a bunch of automated things helping us also in the service area? I certainly see it when I go out. But that's why there are these big themes that we're going to be touching on as we sort of turn the corner into 23. Want to get one more question into you, Andreas, before I let you go. Colin asked, and as everyone knows who's listening, and if you don't, Andreas has been all over the energy situation, especially as it relates to Europe. Colin asking, how could Russia flood without access to enough shipping?
Yeah, I guess what Russia is trying right now is to build sort of a dark fleet, and they will try to ensure the shipping fleet directly, because that is essentially the way that the European Union and the G7 countries try to target the shipping fleet. They try to refrain them from getting insurance if they decide to go with Russian oil, and therefore the Russians are now starting to at least they're attempting to ensure that the global shipping fleet. Whether they will succeed with it is another question, but again, I find it highly unlikely that it is a big deal, since we are already trading below the benchmark. So we need to remember this is an oil price cap, and you are allowed to transport the Russian oil at a price that is lower than 60. So as long as you don't pay more than 60, you're allowed to transport it.
There's one more story that crossed, and I just want to put it on everyone's radar. We're not going to have time to talk about it in depth, but some of our viewers may have noticed on Twitter there were some tweets going around about a report from the BIS about trillions of dollars. I mean, I'm talking 60 to 80 trillion dollars in debt, not on balance sheets, that they're really concerned about in the derivative market, foreign exchange swaps, and they say it's hard for them to track this and anticipate the next crisis. When I saw that, I was thinking, oh, this has echoes of, what we saw in the UK pension system really briefly, that caused a massive amount of concern. It was resolved, but we've been talking about, there's been talk about, whether this sort of ticking time bombs are sitting not in the financial system, the traditional financial system, but maybe in the asset managers, the pensions, and in the derivatives market. What do you make of that, Andreas? Is that something we're really going to have to dig into and pay attention to, or what do you make of that headline?
I think it's a big deal if the US dollar continues to strengthen, because underlying this headline, we actually know which counterparties that are involved in these trades. So these are typically trades made between pension funds in Europe and Japan, and typically institutional investment banks on the other side of the trade in Europe and Japan, and to a certain extent in the US, but not to a large extent. And these are trades that are designed to protect the pension funds against a drop in the US dollar. So what they do is that they hedge the exchange rate risk of all of their holdings of US equity and US bonds via so-called FX swaps. And given that they've purchased more and more equity and bonds in the US, in particular over the past 3 to 4 years at a record pace, right? This amount of FX swaps being rolled over month to hedge the currency risk of these dollar holdings, it's just been increasing at a rapid pace, right? So the issue here is if the amount of dollar liquidity available to the rest of the world shrinks fast enough to bring the pace of the dollar appreciation to an elevated level, at the same time as the amount of dollar liquidity shrinks to such an extent that it makes it very tricky to roll these contracts month over month, because these are all over-the-counter contracts with investment banks, and we've seen such periods in time before. And usually, what happens if shit hits the beep here? Sorry, pardon my French here. Is that the US dollar appreciates rapidly as a consequence of it, and that pension funds will take a beating in these contracts.
Yeah, so it is something we're going to have to watch out for. Yeah. Andreas, great stuff. We have more questions, but don't worry, everyone. Andreas is going to be here all week on the platform, and he's doing some deep dives too. So we will catch up with you as the week goes on. Andreas, thank you so much for helping set us up. We appreciate it.
My pleasure.
All right, so that's big picture. We know what you need to be tracking. Let's bring in Jeff Meyers now. We're going to drill down and go a little bit lower. Jeff, great to see you again. Your sort of area of focus is small cap, but I want to talk about, based on some of the cross currents we just, in macro that we just talked about with Andreas, and it certainly sounds like it's complicated. What does this mean for the small cap space? I mean, what will Fed policy mean for small caps overall?
Well, within the broader technology area, rising rates have been very detrimental to multiples, and you saw that playing out really over the first 3 quarters of the year, without the fundamentals really suffering. And now you're starting to see in the most recent quarter's earnings that the fundamentals are starting to get hit. PC sales are down, smartphone sales are down. And then, semiconductors selling into those markets are down. And now you're seeing some of the, the SaaS software companies, like, Salesforce.com, just reported earnings with slowing sales. So you're starting to see some of the higher valuation companies start to take a hit also. So, we're going from, just purely valuation hits to now more fundamental hits, and where it's going to end up, it's tough to say right now.
Yeah. Do you think that there's been a lot of talk in this environment and we heard, Diego talking about a paradigm shift, and there are others as we've been looking into January and trying to figure out what we need to do before we get there. A lot of people feel like we've gone from an era of passive investing to much more active management. I'm sure that's music to your ears, but do you think that the flows will actually vindicate that idea? Do you feel like a bottoms up approach is going to be able to help you navigate through these really turbulent waters?
I think it is. It really depends. Sometimes it depends on the day you're looking at. Like a day like today, unless you have some really, weighty fundamental news, your stocks will be down along with everything else. So there's been a lot of macro induced movements in the markets with these stocks. But big picture, earnings still matter, M&A still matters, new wins still matter. So, in my view, it always, if you have a fundamental approach, you can always pick your spots and do better than your benchmarks.
All right. Well, you got a couple that you're looking at, so let's take a look at them. And one of them is Net Insight, which is located in Sweden. Why do you think this is going to do well?
So this is a company, very interesting core business, and then they've developed another business based on that core business. So basically what these guys do, their core business is they transport live media from sporting events, through the networks to the viewers. And traditionally this was done by satellite, and they do it over the internet. And that's been, a trend that's going in their direction. So, there's less being done with satellite, more being done over the internet. So that business has been growing for them fundamentally, probably 10 to 15% a year. And then what they did with this technology is they have a way, if you're going to transport media over the internet, you need to be able to synchronize so you're not losing packets and having, judder disrupt the flow of the video. So they've developed this synchronization technique, which has really, which is fundamental to their core business. But now what they're doing is they're using that in 5G. So in order to really get the benefits of 5G, both in terms of speed and latency, you need to have very robust synchronization. And most networks, you hear about 5G networks all the time. Everybody has 5G now, but most of the networks are using older technology for their synchronization. So you're not getting, the full benefits of, of what could be with your 5G. So these guys have this very fundamental new approach. Basically, nobody's competing with them, in this manner. And they secured a win with Turk Telecom, which was their, basically their anchor win. A $20 million contract with Turk Telecom, which is these guys are doing $50 million a year in revenue. So this is a pretty big deal for them. And this is something where Turk Telecom on its own could become a $50 million customer, so basically doubling their revenue. And now they're talking with, they have a Canadian company doing a big pilot with them. They're speaking with T-Mobile, which could be potentially a $500 million win for them. So, this 5G synchronization could be, multiples of where the company is doing business now.
And it's interesting to hear the thing that makes a difference if you think they're going to be able to get a foothold. By the way, I'm assuming that you have positions in these stocks that you're going to be talking about, just for disclosure.
Yes, I do.
Okay. So the ticker on that is NETIB. If you're interested, it sounds like they would be an obvious acquisition target, no?
Yeah, so they would be.
Is that the play you're hoping for? They're also they're I mean, it's only a six and change stock, but they're up 58% in the past 6 months. So that's it's very low, but it's still a big move.
Yeah, so they've been their core business has been strong over the past 6 months, and they did get the initial win with Turk Telecom. So that's driven
what that moved on,
stock price so far. But yeah, an acquisition could be the end game for them. Both Nokia and Ericsson would probably be very happy to have them on board. As this technology is, like sync, has been becoming a much bigger topic of discussion with the 5G telecom providers. Like there's an annual sync conference every year, and it used to be just like the diehard tech guys, and now the more of the business people from the big telcos are coming to this conference. So this is becoming a bigger deal. So
yeah, this is, I guess, as you're seeing 5G, get to the point now where it's actually going to be rolled out and implemented. Everyone is sort of digging further down the food chain. What about the next one? Is it Crayon Holding? Do I have that? No, Crayon, not like
Crayon,
Crayon. What in Norway, right? What is that about?
So what they do is they do something called software asset management. So basically, they come in. Microsoft traditionally has had pretty complex pricing schemes, and what they do is they come into your company and they help you manage your software estate. So basically, right size the number of licenses you need based on your growth and and so that's historically what they've done, and now they've taken that into the cloud. So basically, when you move your your IT infrastructure into the cloud, you need to figure out how many cycles you need at what time. So they help you do that both on a software basis and also on a consulting basis.
No, so is it like sort of like an audit? Are they kind of auditing to find out whether you're getting the best deal?
It is an audit in a pretty software intensive way.
Yeah.
And it's an interesting business now because what they do is they come in, they help save you money. So
I was going to say, right now when everybody wants to cut their budgets, we just heard for SaaS, I guess that's counterintuitively though, it's a good thing. I mean, even though they're in a business that might be getting hit, if they're helping save money, then maybe it's an environment that works for them.
Yeah, so they've seen pretty strong demand over the last 2 quarters, but they had some issues in the U.S. With with attrition, so that kind of hurt their margins in the U.S. and that's what the past couple quarters the stock has been reacting to. But they have pretty we've talked to their U.S. Sales team, and they have pretty strong management in place there, and also the new hires are coming up to speed, so margins have started improving there, and that along with the top line growth should bring the stock back to former levels and beyond.
And the third one we have is Digital Turbine. What's this one? This is US based, is that right?
This is US based, yeah. Digital Turbine. So what they are is they're sort of a middleman between advertisers and telcos. So basically, when you go to a Verizon store, again, new telephone, there usually could be some apps pre-installed on your phone. So they're the guys who say which apps get to be on the phone. So basically, it's like a bidding process, and the app providers basically bid for spots on the phone. And what they do is they take that money and they remit 60% of that to the telecom operators. So basically, the telco is getting a new revenue stream, so they like that. And they have deals with AT&T and Verizon in the U.S. and Telefonica, America Mobile outside the U.S. So these big telcos are pretty happy to get this new revenue stream, and also it's good for the advertisers because instead of having to go to each telco, to sign a specific deal, they just come to Digital Turbine and they handle dealing with all these telcos. So they have this position in the middle, which is strengthened by the more telcos they bring on board and the more advertisers they bring on board. It strengthens their position as a middleman.
It's so interesting. Are all of these businesses cash flow positive? Because we're going into an environment where the cost of capital is higher, and we've seen the double whammy. Small companies get hit by that, but then if you're in tech, it's been a problem too. So theoretically, that's a tough spot to be in. But are they all in a situation where they're cash flow positive and won't be as affected by that?
Yeah, they're all solidly profitable. That's one thing we look at when we're looking at a new position is we want the company to be profitable, because raising money is always tough, and certainly in this environment you want to be trying to raise equity. So that's a prerequisite for us.
Yeah. Is it hard hanging on to talent right now? I mean, this is another thing with, companies this size, management really matters, doesn't it? Your team really matters. And human capital has been an issue. Is that still the case? Is that something you look at?
It's interesting. So it was more of an issue, I would say 9 months ago, when sort of the Great Resignation was still, in full bloom and people were leaving their jobs for better opportunities. But what's happened is actually a lot of the people who left are not so happy at their new places, and have come back to their former employer, and fewer people are being lured away. So actually,
well, we've seen a lot of tech layoffs too, so there's new
Right.
talent on the market as well,
Correct.
that maybe some of these guys can catch. Well, Jeff, fascinating. Thank you so much. You always bring us names that most of us haven't heard of, but in an environment where everyone's looking for opportunity, some really interesting areas to watch out for. We appreciate it.
Sure. Thank you.
Love it. Thank you. Thanks for everyone joining us today. I'll be back tomorrow with Eric Jackson. In the meantime, take care and good luck out there.